Let us get started as it is right about 1 o'clock now, so let's go. We'll look at our beautiful disclosure. Oh, I should have gotten more. Much less organized when I'm in a hotel. All right. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trade. All securities and orders discussed are tracked, monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective offices, personnel, representatives, agents, or independent contractors are in such capacities as licensed financial advisors, registered investment advisors, or registered broker dealers. Nothing in today's webinar, website, or promotional material constitutes promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involve risks. Visit the OCC website, www.optionclearing.com, to read the characteristics and risks of standardized options. PSW provides educational and trading services that are meant to teach you the risks and potential rewards of trading options. We are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you can't afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid in a specific date or identified date. Your results may vary by accessing this webinar. You agree to hold the harmless many losses you may incur as a result of trade of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone. All right, there we go. I got that. Clearly not in the mood for that today. All right. Out, so Canadian down 7%. Okay, now here's the thing. When I'm showing my screen, I have 3 screens, so I'm not quite sure which one you're going to see. I'm not sure how that works, so we'll find out together. But let's give it a shot. Everybody's there. Fantastic, and we will now share my screen. Oh, it asked me which monitor I want to share. 1, 2, or 3. Let's share number 2 and see how it goes. All right, can you guys see my screen now? I have just Google up right now. Let's see. Okay, great. Thanks, guys. All right, what do we want to talk about today? Let's grab the old Thinkorswim window, bring it over here and see what it has to say. Oof, this is really confusing. I'm grabbing it from one place, switching it to another, I think. And of course, please, if you have any questions, participate. No point in doing the webinar if nobody's going to participate. All right, fantastic. Let's see what we're up to here. We have oil. We were trading before, made a little bit of money, and now it's back down. Although not that much back down. Let's see what was happening. Well, you know, we liked it. We liked it at 48. We lost some money. We liked it again at 47.50. Lost some money. Then we liked it at 47, but by the time we got to 47, we had more conviction, so we didn't bother getting back. We didn't get out. We got in it a little more, and we rode that back up to 47.50 and then stopped out as it dripped back down over here. So now it just ticked down to 47.10-ish, and I'm not, I mean, frankly, I don't have time to play with it, so I haven't. But generally, that was the gist of our trading this morning on oil. The bottom line is, look, when you get to around $47, $47.50, we're long. And as you get closer to 45, we want to be longer because we really think that's a good bottom for oil. And it was hugely profitable last week, but you have to have the conviction to keep trading it, okay? I'm assuming you guys can see my Thinkorswim screen while I'm doing this, right? Because I believe that's one that's active right now. So that's, thanks. All right, so that's the one we're at now, and we are also in, well, we're not in that one. I'm sorry, I'm personally out of that one. There's nothing wrong being in it here. I just, I'd rather get in if it's at 47 again, frankly. Now, what I do believe myself in, which is probably losing money, is natural gas. There's natural gas. I don't know, it's not losing money. Look at that. Okay, so now I'm too long on natural gas. My average price is $2.84, which is over here. And what happened? Well, I got one at $2.85-ish, and I got another one when it got to $2.82.50, which is our real entry. But the problem was I just, you know, again, I'm busy. I'm not staring at the future screen. I'm like talking to people and chatting and so on and so forth. So for me, I just wanted to start establishing a position as we went down. So I got in a little bit earlier than I should have. I should have waited for $2.82.50. But that's okay. So my average now is 284 and 2, which is fine. And if it goes lower than 282, at 282.50, I wouldn't buy more because, you know, when you're looking at a 1.5 cent move to get you even, what are you really going to double down for? It doesn't make any sense. All that's going to do is change a 1.25 move to a 0.75 move and a 0.625 move. What the hell's the difference? You know, there's no point in adding another futures trade if it's not going to significantly improve your position. And improving your position by a penny or half a penny is pointless. There has to be some real reason you're doubling down, not just to keep adding stuff. So when you do establish something like this one's establishing out at 284, I really want to be at 282.50. So since that's the case, until we get to 280, where my average will be 282.50, or 282 or whatever, but until we get to around 280, I'm not really interested in adding any more shares here. I want my average to pull down to 282.50, which is where we have serious conviction for our buying. That's the spot we were using all last week on the natural gas futures. It's been very, very effective. All right, so that's my logic on that trade. That trade's illegal only. I don't care. I mean, if that one goes down, if that goes to well, what was it? Well, you know, you always, it's like you always say, I always say I don't care. But, you know, realistically, when it happens, you get really pissed off. So let me see, charts, trade. It's all one thing to say you don't care if something goes low. When you actually sit there and lose a couple of $1,000 bucks, it gets you really pissed off. Forex trader, goddamn. Futures trader, active. I don't have a single chart thing that's really good for this thing. Profit, what does that one look like? That's not so bad. I wonder if that'll do oil. /CL. Can you guys see that? No, it doesn't like futures. That's a shame. All right. This particular setup, this isn't my home setup, of course. It's not very good for like showing a long-term chart. I don't have anything set up for it. Oh, there you go. Wait, this will work. So I can do CL. Maybe. Maybe. Yep, there it is. Okay, cool. Okay, spoke too soon. 15 minutes not enough. Let's try an hour. Okay, that's good. All right. Probably a little hard to read. Maybe I can do this. But you know, I don't care about that other stuff. There you go. All right, you guys should all be able to see this pretty good now. All right, so here's oil. So we bottomed out. Don't forget we're entering a new contract now though. The CL you see now is because the contracts and Thinkorswim roll over automatically. So the CL we're looking at now is March, CLH5. As far as they're concerned, February is dead, even though it's still trading today. So when we're talking about CL, we are talking about the March contract now. Not there. Now I lost it. Yes, right? Okay. All right, so this is the March CL contract. And the low on that contract was 57.81, or about $58. Wait, what? What the hell is that? I've never seen that before. This contract's upside down. Oh, because it's a pair. Hang on. That's funny. All right. Because it's a pair, they're showing in different directions so you can trade the pair. Let's see if this works without its buddy. There we go. God, that was weird. So the low on this March contract is 50.58. All right, so I don't really want to ride anything down from where it is now, from 53. Is this right? Can't be right. Anyone tell me what the hell is going on here? It's like very confusing. What day is this? I don't know. This is not, whatever the problem is with this, it's not a good place to look at it, obviously, because that is not the price of that contract. So for whatever reason, it's not doing the correct thing. Back to active trade though. All right, so ignoring natural gas, which is on track. All right, and like I showed you, I mean, like it was just at 282. I mean, it's just right at 284, and already it went from like 0 to 120. But this one I'm just going to leave alone. I'm happy to add some more if it goes lower. Oil, on the other hand, 47.22. I have no clue what that other chart was about. But well, the point was I was trying to find out what the low was. Let's see if we can do. I guess I can do an hour here. Oh, there you go. Yes, I believe you can see it. This contract bottomed out at 44, so I'm in no mood to ride this thing down to 44. We're not in it. We're flat now. We made made 780 on the day. I'm not jumping back into anything, but if it goes back to the bottom where it was today, so the low of the day was 46.50, 46.60. So if it gets down around 46.75, I wouldn't mind taking another poke at it, but I'm not going to take a poke 50 cents higher than that, especially because this is just about where we just stopped out. If it goes lower, it gets interesting. If it doesn't go lower, we have 2 days until inventory on Thursday, so it's not really worth it. Natural gas is more exciting because we know we have, see, here's the thing. In natural gas, there's a catalyst coming. The catalyst is cold weather, and let's get back into that because we talked about that in chat. Natural gas is way easier during this time of year. During the winter, it's easy to trade because all you have to do is go to AccuWeather, radar maps, forecast maps, and trends, okay? And look what happens. This tells you exactly what's happening. It's warm right now. That's keeping the price of natural gas low. Nobody needs heat. All right, it's not warm like this isn't summer. It's above normal temperature. Therefore, less natural gas is being used in those 1 to 5 days compared to what's normally being used. All right, but then what happens now? So 5, 6 days from now, what starts happening? 6 days from now is like next Sunday. Okay, so Sunday coming up, cold air comes in, and all of a sudden people start getting cold. Now, also you have to realize where gas is being traded. It's being traded in New York and Chicago, okay? So you gotta know your geography too. Where are these things, where are these things trading? Here's the Chicago area, here's the New York area, and what you wanna do is when you see, look how nice that is. See how that's getting cold? All right, these guys are gonna be freezing, and when Chicago and New York are cold, that's where your gas traders are. And they're gonna stay cold. It's gonna be freezing cold 2 weeks. So starting Sunday, and for 2 weeks after that, it's going to be freaking cold. So there's going to be a demand for gas. This week is a low week, but the reason we're long now is because also last week was a very cold week, and there's going to be a drawdown in inventory Thursday. Why is that? Because the trading session, the inventory for natural gas is through Sunday. So it doesn't matter that it warmed up after Sunday. What matters is until Sunday and before Sunday, for the 7 days before, from Sunday to Sunday last week, was very cold. So therefore, a lot of natural gas was used, and therefore, and by the way, cold doesn't mean, it can't be cold at your house. It has to be cold in the country or in a significant portion of the country. So in other words, this doesn't matter. This doesn't matter, that doesn't matter, that doesn't matter. This doesn't really matter much either, but the relentlessly not hot temperatures on the East Coast that's going to go on for 2 straight weeks, that does start to matter. So even if we get burned this week and we don't get the dip we wanted, and even if we get stuck in the trade, at least we know we're going to get saved down the road by some pretty good demand. So for the next couple of weeks after this, we're going to be in very good shape for cold weather. All right, so that's what we're looking at when we're trading natural gas. You got to think about, it's not about the supply now, it's about the future supply, the future demand, and where it's going to be on the chart and how things are going to match up. All right, Declan saying, Phil, I know you've been trading oil and natural gas a lot, but is there a reason you have not traded TF or ES lately? Yeah, because I looked, there's only so many things I can look at one time, and frankly, if I'm into oil and natural gas trades, I'm disinclined. Oh, here you go. See, now we're right back to 284, so people can still get in. So people are disinclined to like start following 10 different things at the same time. And also, look how crazy the indexes have been. You know, it's been easy to call oil and natural gas. That's why I play them. I play whatever the easiest call is. I look at oil. I usually look at oil, gold, silver, oil, natural gas, gasoline, and then the 4 indexes: the Dow, the S&P, the Nasdaq, and the Russell. Those are the things I usually look at. You know, it's what I'm interested in. I don't really like to trade copper. I don't like to trade weird futures. I don't ever trade currencies. And as you can tell from what happened with Swiss franc last week, there's a damn good reason I don't trade currencies. I've been saying this to people for years. It's like, well, how can you trade currencies when you're at the mercy of an announcement from a central bank? That has you have no control. You have no way of knowing what's going to happen. Exactly what happened to these people who would bet against who had bet on the Swiss franc staying weak because they were artificially keeping it weak for 3 years. Those people got burned. I mean, burned in a way. I mean, Jean-Luc put up an article over the weekend. He noted it was a 20 standard deviations away from the normal. I mean, it's not. You couldn't pull that a black swan. It's like a flock of black swans crashes through your window and starts pecking at your eyeballs. It's not good. And if you and there's no stops, there's nothing you could have done on that trade. You just would have lost $20,000 a contract or whatever the hell it worked out to, something like that. $20,000 per contract was how much you would have lost, maybe $40,000 per contract. So, you know, you think you're a clever little currency trader, you make a few bucks here and there, and then one trade can like knock you out for the whole year. Not worth it. You know, the thing about oil is, or gold or whatever, is there can be something that happen and it can go way against you all of a sudden. Like some sudden shock could happen. There could be a war breaks out. There could be a hurricane. There could be, you know, for supply and demand. Gold, there could be even what happens, the euro can drive gold up if you were betting against it down. But you know what? They'll tend to trend back. They'll revert to trend. Currencies don't revert to trend. I mean, you know, obviously everything does to some extent, but what the Swiss did the other day doesn't revert back to trend. They depegged from the euro. So that now they're going to trade at what they should be trading. They always should have been trading at this price. It's what was artificial was where they were before they depegged. And the same thing goes to the dollar and everybody else. It's when one country eases and another country doesn't, there's a vast discrepancy in the way their currencies get traded. And as soon as one of them stops, then they quickly revert back to where they should be, which can be quite far away from where you are. So I don't like currency trading at all for that reason. Other things have a supply-demand underlying issue that you can usually trade on. Currencies don't. Currencies are completely made up numbers by the central bank. And as soon as they start fighting, which they are fighting, now they're starting to fight with each other, that's a bad thing. You don't want to get involved in that. It's like, you know, it's just like dropping in the middle of a war zone completely unarmed when everybody else is using nukes. It makes no sense. All right, so there's that. So that's not why. As to TF and ES, if they hit a significant place that that we feel is predictable, I'm happy to play it. But I mean, Jesus, have you seen these things lately? Hang on, let me grab a chart for this. Like, whoa, that's not the right one. Here we go. Okay. So let's look at the S&P. Actually, the S&P is calm compared to the Russell. Let's look at the S&P. So here's the chart. And we'll look at a month. Okay, so really, I mean, at this point, I mean, 2,000 is not a bad bottom to play for a bounce, but it's hard to call the top. It's very, very volatile. And like I said, the S&P is calm compared to the Russell. Let's see if I can get that one up. All right, I mean, this is an intraday move. It's going up 30, the next day it's down, then it's back up, then it's down, then it's back up all the way here, it finishes the day back here, then it goes down to here, but back up to here, then this day it opens up here, and it opens up here and then flies down to here, but this day it opens down here and goes up to there, and then now today we opened up there and we're down to here. So, I don't know. I mean, it's fun if you want to play it, and it's great. And it's not that we haven't made the calls. We certainly have made a few calls and chat about this stuff, but mostly we've been, we have a huge position in TZA. You know, there's ultra short on the Russell, and it pays off a huge amount of money if the Russell's below 1170. So I don't feel the need also to add. If I thought the Russell was going up, I might want to play it bullish, but on the way down, I have no desire to play it on the way down because we already have gigantic bets in the short-term portfolio on the Russell going down. So that's another thing. It's you know, partially we use our futures trades to offset. Like if we feel we're too bearish, and we are bearish in the short-term portfolio, we're kind of more looking for a bullish trade in the futures, not a bearish trade. Sounds like Phil talking over Phil. Oh, that's not good. All right, let me see if I can participants. No, that's not going to work. It stopped. Okay, well, all right. Let me know if it's a problem. I can kind of try to look to see if somebody's not. It's on again. It's off again. It's on again. All right. Let me see. Here's WebEx. I'm not smart enough to do this. I hate to tell you. I really don't know how to. I don't know how to find people. And let's see, a participant window. Oh, I know what I can do. Maybe try to look at everybody and see if anybody is not muted. Hang on a minute. Let me see if I can figure this out. View all attendees. It looks to me like everybody's muted. Oh, who? Oh, Jim Coe. Who are you? All right, Jim, hang on a minute. Do I have any control? No. Now, the problem is I don't have any idea how to mute you. Let's see what that does. That wasn't good. Oh, dear. All right. Jim, if you are there, could you please do me a favor and just make sure you're not, your microphone's turned off if that's possible. Because for some reason, you are not muted. And I'm not smart enough to mute you. That's it. Everybody else is showing up as muted except for Jim, and I assume that might be the problem, but I really have no way to be sure. So I don't want to blame you, Jim. It's just whatever happened, you came in and it wasn't properly done. All right. Anyway, other than the muting issue, does anybody have any other questions? What do you think about lots of separate interactive brokers? Would you be worried about having your? No. I mean, how many interactive brokers is gigantic. Let's see. Is Interactive Brokers public? I know we never play with them. Are they? Not IB, are they? No. Oh, there they are, IBKR. I never played these guys. All right, so they're $1.64 billion. I bet you they've got a huge amount of that in cash. Here's a Petterfee, or whatever his name is, and he's a billionaire, so I don't think he's going to really let the thing fall apart. Let's take a look. What are we looking at? So they've got annually they're doing $1 billion in revenues. They're dropping about $40 million to the bottom line. Balance sheet. Wow. Well, that's not their money though. $15 billion. You know, they've got $15 billion on the books of cash. This is reflecting their, you know, the money under management, though. It's not reflecting their actual money. Cash flow management would reflect more accurately what they've got. So, you know, they're up 260, they're down 96, they're down 167. I don't think they've got a problem. The amount, let's take a look if we can find out the exact amount. Well, after the close today, you're going to get their earnings, so it will be interesting. Oh, here you go. Statement, all right, $120 million. There you go. So So no, $120 million will not break them. They're very large. You know, if it was somebody smaller, I'd be concerned about $120 million, but they're quite large. It'd be very unlikely that they go. But first of all, if you have all your money in one broker account, that's a bad idea anyways. You really should spread it out. I mean, you learned that, hopefully you guys learned that in 2008, because Merrill Lynch went bust. You know, and so, you know, and so some Bear Stearns and such like that. You know, people got their money, but the more you concentrate your money in one broker, the more you hang it. And it wasn't about not having the money, by the way. It's about that your account was frozen while the market was crashing, and you couldn't do anything about it, because that's worse than not getting your money back, because maybe you get it back, but you get it back a week later after the market's completely bottomed out. That's when you first get to trade again. So when they do give you your money, it's about 1/3 of what it was. So that's what's really scary, is when they shut down a brokerage. And there were outages. I remember in 2008, people who had Options Express were freaking out because the whole system crashed and they couldn't trade while the market was crashing. Things like that. That's what you know, you just never want to have all your eggs in one basket financially. It's a terrible, terrible idea. And there are insurance policies also, but then, of course, look what happened to AIG. AIG almost went bust. And then all the insurance policies that these guys had wouldn't have protected your account either. You know, so it's tricky, and the more money you have, the trickier it is, but the more of a responsibility it is to diversify your portfolio a bit. You know, if you've only got $1 million, if you just have 2-3 accounts, you know, the FDIC is going to guarantee most of that money if you have a couple of accounts. So you're guaranteed by the government, and you're guaranteed by the broker, and they carry an excess carry insurance. But again, like I said, their insurance, if a real broker goes bust like that, and then nobody really did go bust, everybody ended up getting bailed out essentially by the government. But if a real broker went bust, then the company that insures all the accounts in the brokerage would also have some serious issues. So, you know, it's not something not to be concerned about, but it's not something either to panic about, because we do have a lot of safety in our system. Even something as horrifying as what happened in 2008 really didn't cause regular people, to lose their money, other than, like I said, though, the frozen brokerage accounts that didn't open up again until the people were already totally screwed. And then they would open up to margin calls where they had no chance to trade out of it, no chance to put on the brakes, no chance to stop out. That's where you can get in real trouble. All right, and think about it. If you, let's say you have 3 accounts, right? You have money. You have money in in Thinkorswim, and you have money at Interactive Brokers, and you have money at Bank of America or something like that. And let's say your Interactive Broker account freezes, right? But you know what your trades are on Interactive Brokers, and in order to buffer the account of Interactive Brokers going down, you would make counter trades in your Thinkorswim account. You understand what I'm saying? So in other words, it's, you know, you can hedge yourself quickly by adjusting your other account. And by the way, that's the technique we're teaching you with the long-term, short-term portfolio concept. That's exactly what we're teaching you guys, is that you have to learn how to balance. Because if you learn balancing techniques, that kind of stuff won't worry you. You just immediately say, oh, well, I better do this, and then I won't want to worry about losses. Because it's very easy to throw yourself into a neutral position, like we've been for like 3 months now. The long-term and short-term portfolio has been pretty much in the neutral position, just trying to wait to see when the market shakes out. If you learn those skills, you can do that almost any time, like on a day or two's notice, and you can stop the losses, which is very, very important in a crash. And by the way, don't forget that when the market's crashing, if stocks get 40% cheaper and you only lose 20%, you're in great shape, because you can go out with your 80% cash that's left, right? If you cash out with a 20% loss and the market drops 40%, that means that you can take your 80% and buy 2x worth of stock, right? Because the stock, 60%. So you could buy 1.5x at 60, basically, of stock with your 80% you have left, versus having taken the whole 60% loss. So when the market does come back, you have a wonderful windfall. That's why it's great to put on the brakes. That's why it's great to take, even the way we set up our long-term portfolio, it's not bulletproof. It's not going to lose money in a downturn, but the trick is it won't lose as much money. And by not losing as much money, you're in much better shape for the eventual recovery. Now, of course, the overall strategy is we assume there will be an eventual recovery. It's not playing for like the end of the world. So that's different too, but it's always a risk. There's nothing like that's risk-free. But we try, you know, short-term portfolio covering long-term portfolio, we try to make it so it's really, really hard for us to lose money, even in a pretty severe downturn. All right, so next. What were we looking at here? I forgot. Why is this page up? Oh, we were trying to find out about Interactive Brokers exposure. That's correct. So, but this doesn't seem to say anything about it. I don't know why do we fill up this particular article? It seems to say nothing about it. All right, I give up. Anyway, the bottom line is I don't think in the grand scheme of things that these guys are in big trouble, but you also don't want to be the last guy out the door if people are withdrawing money. So, you know, I would keep an eye on it. I would pay attention to the news, and I would see what's going on. Tonight, they're going to have earnings. And look, if you're overexposed, by all means, take some money out. You know, I mean, you know, there's no sense in going crazy. But, you know, especially if it's cash. But don't forget, if you have cash and you take it out of Interactive Brokers and you try to put it somewhere else, what's going to happen? You're going to have a 3-day dead window. So these are the kind of things you want to do right when you think there's going to be a big change in the market. These are the kind of things you really have to do, like to say, I shouldn't have all my money in one place. You know, my grandfather, he grew up in, he was born in 1906, and he lived through the Depression. And I used to go with him on Saturdays. Every Saturday he would do the bank walk, and he used to go to, I would say he had 8 or 9 banks at any given time, and he would have money in 8 or 9 different banks. He never trusted putting, but he had a ton of money in a safe at home. He never trusted having all his money in one place. He always wanted to spread it around because he lived through a bank crash where half the banks just failed and took the money and disappeared. And so that's his attitude. Even though it's like 60 years later, he still has that attitude where he's like, no, this is, you never want to keep all your money in one place. So I kind of got that from him a little bit, where I sort of have a suspicion of the system. You don't have to go crazy. I think 9 banks is excessive because we spend so much time going to different banks. But on the whole, I think I also think it's very bad to have one bank. All right. Who made all the money lost on the other side? That's right. Somebody got paid. And that's the problem for Interactive Brokers, Tom, because what happens is, you know, somebody has an account and the account made money. An Interactive Broker has to pay that person. Now, in theory, they turn around to another person and they say, well, I'm going to take the money from your account. But the problem is, you guys know how this works. You have a margin on your account, and the assumption in the margin account, like on an oil futures trade, for example, the margin's about $4,000. $4,000 is a $4 move in oil. That's a pretty big move. So it's not likely that you blow through your margin in any given day. They don't charge you $8. They don't charge you $10. Even though it's possible for oil to move $5, $8 in a day, it happens so rarely that your broker kind of assumes the risk. And we were talking about that on the weekend too, about the standard deviations of risk. So the broker, in order not to piss off the customers, assumes some of the risk for those black swan events that are more than 1 or 2 standard deviations. So their margin requirement is for a normal amount of movement, and they consider a normal amount of movement on a futures contract to be roughly $4,000 up or down. That's the way they generally price them. They have about a $4,000 margin. So you look at the currency thing, and you say, well, okay, fine. So when anybody's given futures account, they've got a $4,000 cushion when they make a bet. So there are guys who had a lot of margin tied up in those European trades, especially when doing like butterflies, not butterflies, I'm sorry, condors, where they're selling a spread on the put side, selling a spread on the call side, and their assumption is that they're going to come out in the middle. So they do a lot of it on margin, and they make a little bit of money a lot of the time, like almost every time, because for 3 years. The Swiss had been artificially keeping the Swiss franc at about 1.2 euros. Then all of a sudden, instead of moving by €1 in price, instead of deviating by 1%, the thing went 20, 30% in a single day. So that is 20. The one standard deviation is 1%. This went 20 or 30%. You're talking about 20, 30 standard deviations. It just completely blew through all the margin requirements, and that means that there are people whose entire account got margin call. and they don't have the money to cover it. And those people don't have the money to cover it. If they don't have the money to cover it, Interactive Brokers is the one who gets screwed because they have to pay the people who made money while they can't collect the money from the people who didn't make money. So when you hear that Interactive Brokers lost $120 million, that's, and by the way, we figured it out, it's about $20 billion was lost on the Swiss franc move by currency traders. But most of them have the money. Most of them, like hedge funds and big, the big boys trading, they've got the money. They lose a couple of billion, they lose $1 billion. They have to go sell some shit. They sell some Apple stock, they sell some other stock, and they cover themselves. That's just life. Some people lose, some people win. The broker, that doesn't affect them. They don't give a crap about that. When you hear that Interactive Brokers lost $120 million, it means that the customers, they didn't lose just $120 million. They lost $120 million more than they had. Now, mostly the guys who lose $120 million to Interactive Brokers are small accounts because it's individual retail suckers who do that. If Goldman Sachs loses $5 billion, Interactive Brokers is like, hey, Goldman, write us a check. They don't give a crap what's in that account. They know that Goldman's got deep pockets, and your broker contract, if you ever actually read it, which is nasty, it is you owe them everything. You owe them your life, your company. You pay all the legal expenses, blah blah blah. There is no chance in hell you don't hand over your cash to a broker company if you make a bet and you lose. So, and that's true for corporations and everybody else in hedge funds. So unless you want to bankrupt your fund and bankrupt your company or whatever, you are going to pay off your debt to your brokers. Okay, it's like a loan shark, but it's worse because instead of breaking your leg, they send lawyers after you. All right, so you do not want to mess around with those things. So when Interactive Broker says they lost $120 million bucks, it's $120 million of money of people who just flat out couldn't pay them and their accounts busted and they can't get them. They can't hold their assets. They can't do anything else right now. Down the road, though, they still will. Down the road, they'll foreclose on their properties. They'll take their wives and children. They'll sell them into slavery. Whatever it takes, they'll get their money back some way or another from everybody who can possibly do it. Plus, Interactive Brokers have some insurance, so none of it's too bad. So on the whole, with Interactive Brokers being like a $2 billion company or whatever we decided it was, what's the say up here? 1.6 billion. So you're talking about, you know, 120 million is not even 10% of their total market cap. It's survivable, even in that. And let's see. So now we're catching up. And let's see. Texan Butterfly. I wanted to have January put expired Thinker Flame close last week. You had it selling April 47, $4. That's now 68. Would you wait for a down day to sell those or select a different strike? Uh-oh. That I don't have set up at all, so I'm going to punt. I do not have that portfolio set up here, and I am on the road, so I'm going to punt that question. I don't quite know what that is on the Texas Butterfly, but let's see. You waited to have the January put expire at 10 cents. Okay, that's fine, and I don't know if it expired worthless or not. You had to sell in the 47 put $4. They're now 68. Well, that's a good thing. Would you wait for a down day to sell those or select a different strike? Well, I'm confused because it means that you didn't sell the puts that you were supposed to sell. Right? You had to sell in the 47 puts, those now 68. TXN. So I'm not sure what the question is. If you didn't sell it and you were trying to sell for $1 and they're now 68, I would wait because let's see how this 54 up here resolves itself and whether or not Texas Instruments, let's take a look. TXN, oh, they had earnings already, didn't they? No, they didn't. Okay, I'm sorry. So it's this week or next week. Next week. So it's like the 20th. It must be next Monday. So their earnings on Monday. And I don't see that this to me is probably going to, unless the market takes off, which I don't, obviously is not happening right now, although NASDAQ's green, that's nice. Unless we start to really take off, and again, you've got QE, you have so much weird stuff going on, it's hard to say. But I do think they're toppy here, and I do think they're going to head back down. They're probably going to test 50. I really wouldn't, if you didn't get your price for the put, April 47, yeah, I mean, it's almost pointless to collect 68 cents for April, right? You're better off selling a higher put. So if it goes over 54, and holds that line. You see how that line there is the down-sloping thing? If you break over this trend at 54, then you kind of have to give up on the 47s, which is never going to happen anyway. And probably, you know, if you can sell the 49s and get a buck, the idea is to get a buck. Let's put it that way. That's your top priority. Like, get a buck, and that offsets the short calls. All right, so JPM had earnings already. Would this be a good time to open up a JPM? We did. Well, what do you mean open it up? We already have it. Oh, I'm sorry. Any time's a good time to open up the butterfly. Really, it's just a concept. You know, you just have to pick the right spread. And again, let's do this next week with butterflies because they're complicated, and it'd be better if I could actually have it in front of me and take a look at it. But you know, it's easy enough. You're just going to pick similar strikes and try to sort of like nail where it's going to be. So with JPM. Oh, am I doing stuff you can't see? Yeah, I am. I'm sorry. Hang on. I just realized I'm doing things on screen you can't even see it. All right. That made no sense in what I was just saying. Here you go. There's Texas Instruments. This is what I was pointing to when nobody was telling me I wasn't. Up here, 54. See this descending angle, right? So as soon as you make a higher high here, over 54, and it holds, then you can say, okay, we're never going to get the money for 47. Then say, well, whatever's a buck. That was the point, was to sell whatever you can for a buck. Now, moving on to JP Morgan. JP Morgan had a nice dip. It held this trend line, though, for now. Look at this here. It's a pretty solid, good line you can follow. So it held this line for now. So if I was going to pick a target for JP Morgan, I'd pick around 55. I'd probably sell the 55, put some calls. All right, and let's see if Thinkorswim tells us that. And of course, the longs are essentially, you know, I mean, the idea is just to spend not too much. So very quickly, JPM. Very quickly, if you look at the 55 puts and calls here, it's $1.80 plus $1.20 is $3, right? If we sell the Marches, we don't want to sell the Aprils because then we're getting back into earnings. If we sell the Marches instead of $3, we get $4. That's not worth it. So if we only get like $4 or $4.50 for March, but we get $3 for February, then of course we're going to sell February instead of March. It makes no sense to sell March. You're not getting enough more money. You're taking more risk. You're taking twice the time in risk, but you're not getting paid twice as much, so you don't do it. All right, so we want to sell the February 55 puts and calls. This is right about there. The idea is to sell as much premium as possible. It doesn't matter whether you're right or wrong, really. So you can sell that premium for $3. Now, knowing that you're collecting $3 in premium, you say, well, what 2017s can I buy that aren't too much more money than $3? Well, the 45 puts are $3.85, but you know what about the 45? I wouldn't be as worried. To me, I don't think JP Morgan is going to really drop. I think I'm on the whole more bullish on JP Morgan staying at a reasonable price. So I don't think I'd really want to be tight on that side. So I think I'd probably sell the 40 puts. And I have no idea what we actually have in the butterfly portfolio, but I'm just saying, like, from scratch, I would probably sell the 40 puts because I only want to protect myself against a catastrophic loss. I don't want to protect myself against an ordinary loss. I'm not looking to be bulletproof here. The idea is that if JP Morgan was bankrupt, I'm limiting my loss exposure to about $15 from the 55s to the 40s is my total loss, less the $3 I'm selling now in premium. So I'm limiting my exposure to $15. I expect to make, if I'm selling $3 in 1 month in premium and I got 24 months to sell, I'm going to collect $60-something over time. So I certainly, if my downside exposure maxes out at 15, I'm pretty comfortable with that trade. All right, now we go to the upside. I do think JP Morgan will be more expensive than 55, so I don't want to spend too little here. So I think I'd probably go with the 65s here, or actually see the 6250s are barely any more money. They're only like 75 cents more. So I think the 6250s for, you know, like about $4, $4.10. So I think I'll go with the 6250s long to cap my upside exposure to 750, but on the downside, I'm willing to let it slide $15. But that also is going to then affect my future betting because since I know I have more downside exposure than upside, I'm always going to err on the side of portions of the downside to protect myself. And that's it. That's all it is with that strategy. You just have to, with each stock, you have to think about what's likely to happen, what's your long-term view on the stock, what's short-term, where do you make your best premium, so on and so forth. And once you get used to all that stuff, it's not very complicated. Brian, let's see. Interactive Brokers. It was not exposed to the franc well, of course, it didn't specialize in currency. The amount of 20 million, the company noted it was less than 2.5%. Okay, well, yeah, okay. That's pretty much what we were talking about, right? Very nicely summed up, Brian. Brian, by the way, you said that privately. Please, all you guys, please make sure you chat when you're chatting to all participants. Okay, because that way it doesn't sound like I'm talking to myself. Okay, thanks. And then Brian had a good link and all that, but the problem was he only put it to me privately, apparently. Yodi says, oil 47 again. All right, great. That's a fantastic time to buy more oil. Ding, 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 ding. All right. Active trader. Ooh, here's natural gas is below my line. That's okay. So here you go. So oil 47. I don't really need to think. I know I like oil at 47. So I buy one contract at 47. Now we see what happens. How low did oil go? 46.50. So at 46.50, I know I want to buy another one for sure, and that would average me at 46.75 would be my average if it goes low. If not, I'll hold it. But this is what's called a conviction entry. If I didn't have conviction, I would just go in at 47 and stop out at like 46.95, take a $50 loss, and then wait and see what happens again. As it goes back over 47, I'll do it again and take another $50 loss. It's like just losing 50, 50, 50, but eventually, hopefully, I'll get a nice little run and make some money. All right, but as this stands, I'm very happy to grab one at 47. And as it goes down, I don't mind getting another one. Maybe at 75, I might want to get another one. Way down here. Right? So it looks so far away when you do it like that. So it's way down there, 47.75. But I'm in no hurry. It's not an emergency trade. I just would be very happy to get back in this trade again. But I am in this trade. I'm long 147. And if it gets back to today's high, which was 48 and 25, then I will make $1,000. So I don't see why I need to be greedy, right? If I can make $1,000, if it does what it did before, why would I start going crazy about my amounts of contracts here? It's like one contract's fine. All right. So goes to 48. I'm going to make $1,000. If it goes down to 46.50, I'm going to add one, and then I'm going to have two at an average of 46.75, and they'll be down total of $500 on two contracts. Now, of course, I want to get back out if we get a bounce to 25. If that fails and it goes back down all the way to 46 even, from 46.50, I would then add two more, and I'll have four, and my average will be 46.50, I believe, on four. Now, 46.50 is an amount I really like. I'm willing to hold for quite a long time, 46.50, and you can see why I like that. Don't you want to be in at 46.50 on four contracts? That's a good spot. And if it goes to 45, I really don't mind going longer at 45 because, again, it's just too low. And this goes back to what we constantly talk about. It's like there's a value to oil. I believe oil is worth more than $45. I don't care if it spikes down. That doesn't change what it's worth. All right, so I don't know why the 40 puts this from Pat, but whatever. Oh, I see. Okay. 46.62 is a low day. Yeah, well, whatever the exact number is, but that's okay. Look, I mean, an example right here. Look at it fly down. Now, what's going on? Is anything special happening? You know, when I really get into making a conviction trade, charts, wait a minute. Charts. There they are. So when I really get into making conviction trade, it would be because of various factors. I see the dollar is up. So that's a good reason, actually, to be long on oil. The dollar is up, and it's pushing oil down. The other thing we did earlier is the reason we liked oil when it got down to about 46.50 is because that was a 5% line. So of course we expect to see a bounce off a 5% drop in oil. That's easy. Oh, here's 282 on natural gas, down 10% for the day. Holy crap, what a bad day. Gasoline's having a bad day too, but it's not at that 130 line yet, so we're not interested in that. But these guys, 2825, that's our number. All right, so let's replace the Russell with NG. And I've already got 2 long. I'm down 260 on those. That's okay. I may as well add, this is our spot, so I'm going to add 1 more here. So now we have 3 at 2833. Now, obviously, we get back to 2833, which is so close. Look how close it is. We get back here, 2836, actually. So right there, I may as well just put in a sell. For sure, I want to sell if we get a bounce. If we don't get a bounce, if we go lower, I'm willing to buy another one. And that'll drag my number, that'll drag all 4 down. So if I want to get to 2825, that is 1.2 below there. And so if I have 3, and I need my 3 to be 1.2 below, then they all have to be 3.6 below, right? So at 3.6 below, the average would drop 3 of them 1.2. And that means I take 3.6 away from my target, from where it is now. So I take away 3.6, so it's 280. So 280 is the next time I would want to buy. And that's going to give me a little pull down to be where I want to be at 2825. But I'll be down, if I do that, I'll be down about $1,000 on the 4 contracts when I'm in that trade. But again, this goes back to it's convictions, different than it's different than a stopping play. It's a conviction play. And frankly, when we're doing these seminars, I always do the conviction plays because this time of day, it's what you end up doing. You know, you get into these shoves where things get pushed around as you head into the close. The NYMEX closes in another half hour. So you're getting shoved out of positions and trying to push the bulls out ahead of any kind of inventory change or something. So that's what we're looking at here. All right, so, and again, you don't want to force it. I'm not trying to be a hero. If I get a little bit lower, I kind of want, with oil, oh, I only have 1 contract, stupid. All right, well, I definitely want another one. So I'm going to, as soon as I think it's not going to keep going down, like right about here, it's just I really don't want to let this get away. Okay, so 69. See how I'm watching it at 69, 68. Then I reset my spot at 67. I'm going to follow it down. 68. I don't want to see 70 now. If I see 70 now, I'm going to want to buy. 67. Ah, shit. All right. Screw it. I don't think it's going much lower. Oh, you bastards. They won't fill me. I was too greedy. But you see, just watch it and see what it's doing. And then you say, okay, you know what? It's not going to, it doesn't seem like it's getting any lower. So before I miss my opportunity to get a fill, I'm going to take my shot here. Now, I still might get it. And you know what? And you know how you can tell also when you're watching these things? You see how there's like big blocks here? 26, 26, 23, 28. That's a lot of people trying to sell contracts. Here, 8, 25, 25, 30, 40. There's a lot trying to buy too. So you can see that's going to be a point of contention. Sometimes you see a real discrepancy. Like here, like right here, 27, 27, 16 versus 35, 15, 6. It means that we probably down around here is going to get hit again. But if that doesn't happen, then you have to say, well, then see, it's actually eroding. These guys are getting taken out one by one. Those things climbing back up. What the hell was that? Oh, see the gasoline, the natural gas spiked up and hit my my mark. Now I'm back to 2 contracts at 2829. Isn't that exciting? I'm thrilled. They're both now they're actually positive. And that's what you call laddering in and laddering out of a position. So what did I do? As soon as I filled my 3rd contract, I looked to sell that 3rd contract back at an even price. And what that does is leave me effectively with 2 contracts at a lower basis. And it's the same thing with oil. If I do get my 2nd contract, which I'm not getting, so I'm going to take it off, and I'm going to see if they maybe will go down after I take it off. if I do get my second contract, the first, what you want to do is just improve your position. I'm not getting in and doubling down to have double the risk. I'm getting in to double down because it gives me an opportunity to get out with a small profit, which then pushes the basis of my remaining contract down. So then I'm super comfortable with my one contract at a very low basis. And you can do that over and over again. Every time you make a dime on your second play, you lower the basis of the original play by a dime. So think about that. If you do that 10 times, if you just have to catch a dime 10 times and lower your basis, and don't forget, you're only doubling down, you're only adding a piece when it's below your original entry. You don't add above your original entry unless you are following a much more complicated strategy that we're not even going to discuss. But as long as you're, if you're just trying to do a minimal amount of contracts, you ladder in and you ladder out. And the laddering, just think about it that way. You just want to, as it goes below your strike, and you find a different floor, obviously you have to believe that that's going to be a floor. So in other words, when I'm looking at oil, I don't remember where we came in. We came in about 47, obviously. So at 47, I wanted in again. It goes below 47, but not low. And oh, wait, we're below 47.70 again. Nobody's told me. Guys, oh, no, we're not. 46.70. Anyway, so so we got below 46. When we got to 46.70, if I had managed to add that, I would have knocked 15 cents off this, and it would have been 46.85. And I would have been very comfortable having two at 46.85. I couldn't make that entry initially, but I'm kind of comfortable with this being a floor because it's already held up as a floor. But as it stands now, I don't really have any reason not to believe that's going to hold up.